Welcome to the Explainer. So, in January of 2026, the precious metals market went on an absolutely historic rally, right before a catastrophic crash. It all happened in just a matter of weeks. Today, we're going to break down exactly what happened, why it happened, and most importantly, what it all means for you. Let's get right into it.
Okay, let's just start with the single most important number from this entire event. On January 31st, the price of silver didn't just dip. No, it fell off a cliff. We're talking a brutal single-day flash crash of over 31%. I mean, that's just an unbelievable move for what's supposed to be a stable, safe haven asset.
And to put that number into perspective for you, this was not just a bad day at the office. This was the single largest collapse in the precious metals market in over 40 years. In just a few hours, weeks of these record-breaking, absolutely euphoric gains just completely evaporated. So, the obvious question is, right, what on earth could possibly send a classic safe haven asset into such a violent nosedive? Well, to really understand the crash, we first have to look at the incredible rally that came right before it. You see, the month of January saw what a lot of people are now calling a super rally. It was fueled by rising tensions between the US and Iran and a pretty weak US dollar, so investors just piled into hard assets. Gold soared over $5,500 an ounce, and silver, get this, rocketed past 120. But then, on January 30th, that whole speculative bubble just popped, and prices collapsed dramatically. An earthquake of this size always has an epicenter, right? A specific trigger. And in this case, the prime suspect wasn't some market failure or a bank going under. Nope, it was a single political announcement coming out of the White House. The catalyst was President Trump's nomination of Kevin Warsh to be the next chairman of the Federal Reserve. And Wall Street reacted instantly because Warsh is what's known as a monetary hawk. Now, all that means is he's a policymaker who prioritizes fighting inflation, which, you guessed it, often means raising interest rates and strengthening the dollar. And this is where it gets really interesting. How this one nomination created an immediate, almost perfect domino effect. The market instantly priced in a stronger dollar, which makes gold and silver more expensive for anyone buying with foreign currency. At the exact same time, bond yields spiked, which makes assets that pay you interest way more attractive than metals, which don't. This combination was the perfect trigger for all the trading algorithms to just begin a massive automated sell-off. And if that was a fire, well, the CME group showed up with a tanker full of gasoline. The CME is the world's biggest derivatives exchange, and in response to all the chaos, they raised their margin requirements. Basically, they made it much more expensive for traders to hold onto their positions. This forced a massive liquidity flush, which is really just a rapid forced sell-off because leveraged traders had absolutely no choice but to sell immediately to cover their costs. But here's the crucial point. While the paper price on Wall Street was in total freefall, a completely different and frankly fascinating story was unfolding in the real world, with actual physical bars and coins. This is what people are calling the Great Divorce. And this just illustrates that disconnect perfectly. On the very same day that paper silver futures on the COMEX exchange were crashing down to around $80, actual physical silver in Shanghai was trading hands for nearly $120. That's a staggering premium of almost 50%. The paper market crashed, but the physical market, it held strong. So why the huge split? Well, it's because there's a real-world structural deficit for physical silver. Industrial demand is just exploding from sectors like AI data centers, electric vehicles, and solar panels. And at the same time, China has been restricting its exports of the metal, which squeezes an already tight global supply. The bottom line is, there just isn't enough physical silver to go around to meet demand. Okay, so what does all this crazy market chaos mean for the average person? Well, it turns out this has a direct line to your wallet, and it's not just about investments. Because of that sustained high cost for real physical silver and other components, you should definitely expect to see some significant price hikes this year. We're talking 5 to 20% on consumer electronics, think smartphones and laptops, and price increases of about 10 to 15% on sterling silver jewelry. And, whenever you see this level of volatility, you also see a surge in those pop-up gold and silver buyers, the ones that set up shop in hotels or malls for a weekend. You need to be extremely cautious here. Many of these are predatory operations just looking to take advantage of all the confusion. So if you are thinking of selling some old jewelry, please protect yourself. First, always go to a reputable local dealer, someone with a permanent storefront, never ever a temporary pop-up. And second, ask them for their payout as a percentage of the spot price. A fair dealer should be giving you at least 80% of the metal's market value.
So after all that chaos, we get to the billion-dollar question that everyone is asking now. Where in the world do prices go from here? And let me tell you, the experts are completely split down the middle.
Was this flash crash just a necessary correction? Something that washed out the speculators and is now setting the stage for the next leg up? Or was that it? Was that the final, frantic peak of a historic bull run that is now officially over? Honestly, nobody seems to agree.
You've got the bulls, like the analyst over at Citigroup, who sees silver roaring back to $150 an ounce. UBS is targeting gold at $6,200. But then you have the bears, like the respected analysts Marko Kolanovic, who are warning that the January rally was a speculative melt-up and that prices could easily correct another 50% from here as that speculative fever breaks.
All of this leaves us at a really fascinating crossroads, and it leaves us with a final provocative thought. Was this historic flash crash just a freak accident, a perfect storm of news and automated trading, or is this extreme, gut-wrenching volatility the new reality for our money and for our markets?